Thank you, Andrew. Thank you so much for raising your perspectives on the role of the debt restructuring, which is very complex, and also the role of the NDBs. So I think we have 15 minutes for questions and answers. Pablo, please.
Thank you, Jianhai. So I want to ask a bit of an unfair question, which is what do the presenters think about the way the GFSN worked in the Eurozone crisis? Why? It is unfair because it's a very difficult question, but but the issue is that most of the topics that have been discussed here were present in the way the Eurozone crisis evolved. You had the relationship with the IMF, with an RFA. You had the reserve currency issuer, the role of the preferred credit status of the IMF, the use of market financing by the RFAs, the issuance of bonds by the EFSF and DSMs. This very interesting game theoretic mixed strategy approach is like the role of the ECB dealing with the different political constituencies during the crisis. Debt restructuring, of course, the role of systemic shocks, the use of the systemic exception for the debt sustainability analysis. So it is a very clear case of the type of things that we want to discuss when we think about how to have a GFSN that works properly. And one can argue that it worked very well because the Eurozone is still there. But also one can think that maybe a number of issues could have been done better. On also a question for Andy on the comparison between debt to GDP in the reprofiling versus restructuring. Isn't this due to the way we price public debt, and we can have this fantasy that we have a very large haircut in terms of net present value, but without an upfront haircut of the level of debt, and therefore you have debt relief, but it doesn't show in the statistics, and everybody seems happy about it. And therefore it allows to do it without showing that it actually happens. That might be a problem. Thanks.
Thank you, Pablo. I think I see a number of name tags up there. Yes. So how about let's start from this side onwards, then I'll come to you. Yes, please.
Thank you. I have a question for Javier Guzman on the FCL, because I am a fan of the FCL. I find it is a very useful facility by the fund, but on the other hand, I think it is very costly in terms of fund resources. So we've seen that the amount of reserves at the global level is really huge. What if all these countries that are holding those reserves decided to go to the IMF for an FCL to cover which part of their reserves? So I just wanted him to reflect a little bit on this, how the FCL can be financed if more countries would go to the IMF for this instrument, and if the Bank of Mexico has made any reflection on what is the percentage, for example, of required reserves that may be covered by the FCL, which is there an optimal there? Thank you.
Thank you. Jen, please.
Thank you. I think these were three very interesting presentations. I have a question and remark for Javier first. And the question is whether Mexico was not a very specific and unique case in aptly using the swaps and the FCL in a very smart way, and avoiding any kind of stigma, and due to its standing as a large emerging economy and a close relationship with the fund for a long time. My guess is that the fund is facing a big strategic choice in this matter, because there are a very important distinction which is important between conditional liquidity and unconditional liquidity. Unconditional liquidity, and you cannot be semi-conditional. And in my view, that's the reason why the FCL and PCL are a little bit not that successful. They are semi-conditional, so they carry all the stigma associated with conditionality, in a sense. And Mexico is an exception. Maybe Poland too, if I remember well. But in crisis, and the only substitute to foreign exchange reserves is unconditional liquidity. So in crisis, you need unconditional liquidity if you want to face up a big capital outflows. So if the IMF wants to produce a form of liquidity which is absolutely substitutable to reserves, it has to be unconditional. That's a big genetical change for the IMF, because all the IMF is about conditionality. So I think this debate cannot be sort of circumvented and avoided, and they have to make up their mind. If the IMF stays as it is, and I think it's kind of a good idea, then you could think of kind of task distribution between conditional liquidity provided by the IMF and unconditional liquidity provided by central banks according to their own swap arrangements. And I think that is a natural power sharing. If the IMF wants to stand up to its ambition to be a kind of hub for global liquidity, then it has to think whether it wants to stay conditional or not. It seems to me this is the basic lessons that we can see from the accumulation of foreign exchange reserves. The second, I had a lot of points to make, but I'll go very fast. The second point, and of course this conditional and unconditional is closely linked to whether countries are hit by a systemic or an idiosyncratic shock. So I don't think the policy answer should be the same in both cases. Basically, if a country is hit by an idiosyncratic shock, conditional liquidity makes sense. If the shock is global, unconditional liquidity is what is needed. So that there's a need some clarification in terms of concepts and attribution. Then there's a question about the link with the SDRM. I would say we shouldn't think the lender of last resort taking into account the SDRM. We should think it the other way around. We should think the SDRM and in terms of its implication for the lender of last resort. The SDRM has a very ambiguous effect on the liquidity provision. You can say on the one hand that it reduces the need for liquidity because part of the shortfall is met by haircuts on existing debt. On the other hand, it makes debt much more risk sensitive, the simple existence of the RM, and it can create the possibility, in my view, it multiplies the possibility of runs on the debt and increase the liquidity needs. So my sense is that the SDRM, if it is implemented, or if the CACs are implemented, it will increase the need for liquidity provision. It will not reduce it at the end. And I think these effects should be, I may be wrong, but I think those effects should be finely balanced and finely studied before we massively engage into SDRM, because it may help solve solvency crisis, but it may help multiply liquidity crisis.
Thank you. Alejandro.
Yeah. I mean, I felt a little bit unease on the first two presentations, because on the discussion of the swap lines and on the discussion of the regional reserve arrangement, we ended up falling back on the IMF. So in that sense, I mean, I would have my question is basically, do we see swap lines and regional reserve arrangements are second best solutions, given that we cannot increase the size of the IMF? Because at the end of the day, I think what I kind of got from the presentations is that given, I mean the analytical structure that Andy presented, I mean, the only way in which Advanced Economy Central Bank will extend their swap arrangements to emerging market is if they are sure that in the next decade, none of these emerging markets will have a solvency crisis. It will only be liquidity crisis. Given that that assumption has a very low probability, Advanced Economy Central Bank will not get into the business of assessing credit quality of emerging markets, and therefore the assessment of the credit quality will rely on the IMF. Whatever conditionality that has to be imposed will rely on the IMF, and we only kind of do some window dressing, channeling the resources through the central bank, so we reduce the stigma. So we go back to the issue of governance, and if we solve the issue of governance, then we can increase the size of the fund and have the size of the fund that we need, and there we have the right governance structure to actually undertake the design of liquidity facilities and crisis facilities, etc. So is there something else in swap lines or regional reserve arrangement, etc., that I'm missing, or it's just the lack of visibility of increasing the fund and the political reality of going to a second best solution through these complementary facilities? That would be one question. I think second question that would be interesting for us in this table is to understand a little bit more from the Bank of Mexico, from the Central Bank of Peru, etc., what has been their logic in terms of intervening in the markets? How do they think of reserve accumulation? Because publicly, it is hard to read in any public document what are your objectives when you accumulate reserve, how much you want to accumulate. The IMF has a reserve adequacy metric. All of these things are perfectible, but what is yours? How are you thinking in terms of using this instrument in a precautionary way, etc., to provide certainty to the markets and not that this instrument becomes an additional source of uncertainty because people do not have enough information to assess how you're using that. And finally, I really enjoy Andy's presentation because I think if we don't start for some kind of first principles, we don't understand how market or design of new market instruments. We want to make that more bail-inable. We want to make we want countries to fund themselves more in equity-like instruments. We want to improve even our lending framework at the fund. All those changes have to be thought together with the size of the global safety net. So I think it's very hard to discuss these issues in isolation, and I really enjoy that part of the presentation. And here I think the issue of GDP-linked bonds, commodity-linked bonds, and reprofiling, etc., should be a key part of what we're discussing. And I think the last point of how we think of multilateral development banks, not only providing a counter-cyclical role, but actually becoming a vehicle. We keep on saying that in a zero-rate, low-growth environment, countries should undertake a significant infrastructure effort, etc. On the other hand, rating agencies keep using the same methodology and logics, and countries are afraid to expand their balance sheet to undertake this infrastructure. And multilateral development banks should be the vehicles through which in the next decade we intermediate a lot of these savings to provide a huge infrastructure push. And I think we're facing the restrictions that you mentioned to accomplish this. And maybe in addition to your comments, what could be other financial innovations that might help to break this paradox?
Yeah, I have some comments for Eduardo Levy regarding the proposal. I understand that the key of your argument is the automaticity of the line. But then I think still these lender of last resort facilities have moral hazard problems. For example, in our lender of last resort mechanisms, banks still face stigma. They are reluctant to use that. Then second, the use of this facility involves conditionality. Yes, you must restrict the growth of your assets, or you can not pursue some types of operations, and that is non ex ante in the functioning of the line. And then in the case of sovereign countries, there is a difference from banks, and this is a political economy problem. Usually the authorities that get into trouble are different from the authorities that in the end will use the lender of last resort facility. And that poses a problem because the penalty cost of using the line is not internalized by the authorities that caused the problem in the first place. And then I have a question for Andy. Could you expand on these insurance mechanisms provided by the private sector for sovereigns? Thanks.
Thanks. Excellent presentations. I just felt there was a little bit of a disconnect between our session today and the session yesterday on capital flows, and I wondered whether the changing nature and profile of capital flows that we heard about yesterday increases in the eyes of the panel the case for unconditional liquidity or ex-ante insurance. And here I was thinking in particular of the work of Ms. Gupta, which sort of seems to indicate that there'll be more of an innocent bystander problem, that innocent bystanders are more likely today than perhaps 15 years ago to be hit by sudden stops. And second question was sort of, I guess, slightly building on Alejandro's first, which is that, Governor Guzman, you set out a case that the IMF should be at the centre of the safety net. But the case you made was quite a pragmatic one. It was essentially, we should use it because we have it. It's got excellent resources, excellent staff that we can draw on. But across the presentations, I sort of wondered if we were building towards like a first principles case about why we need the fund, and if we didn't have it, we would need to invent it. And essentially that would be that limits of the central bank's mandates, that RFAs, if we were relying on those, maybe overwhelmed by regional crises, mean that we need the global multilateral to be at the centre of the safety net.
Yeah, I really enjoyed the presentation by Andrew Powell, and I wanted to strike a somewhat more optimistic note. I think, as you pointed out, Andy, the global financial safety net is tightly linked to the debt restructuring mechanism, but I actually think we've made a lot of progress in redesigning the sovereign debt restructuring mechanism. It's not just the introduction of the new CACs, so the ICMA aggregation clause, which basically does away with the holdout problem, but it's also the reform of the IMF lending framework, which was passed earlier this year. So, when anybody wants to have more than 500% of quota, either they satisfy the 4 criteria of the exceptional access framework, or when in doubt, you do an upfront debt reprofiling. And I actually think this is going to become the new standard situation. It has already been applied in a way in Ukraine. It should be applied in the case of Venezuela. So when you have a situation where debt sustainability is in doubt, and you're facing, a dispersed set of private sector claims under different jurisdictions with different CACs and so forth, what you do, you just reprofile everything, ex ante, before you provide any kind of financial assistance. You sweep it all up. You put it into a new structure with aggregation clause and decent legal languages, and then you do away with a big chunk of the financing requirement in the coming years, because you have zero maturities for a couple of years. And then if you do need to restructure and a haircut at a later stage, you can do it very easily, because everything is under the same jurisdiction, the same law. So I think we actually do have a very, very good framework right now. And I think that the new standard procedure probably will become ex-ante rescheduling. Now, you sounded very skeptical with respect to rescheduling. I actually think that rescheduling is pretty good. I mean, there are a number of advantages, just 3. The first one is it reduces the structural subordination of private creditors. So, today, when you have a country that gets into trouble, and you've got debt falling due every year, and then the IMF comes in and bails out the holders of short-term debt, and the holders of long-term debt are left. But these guys actually become structurally subordinated because they have a junior claim now, while the seniority is rests with the IMF. So if you do debt reprofiling and you reprofile everything, you do away with this problem of structural subordination of private creditors. The second advantage of reprofiling is it increases the information content of market prices. So today, when you look at spreads, very often you find a situation that the short-term paper trades at very low spreads, not because people think that it's a good country, but because people think they're going to get bailed out by the IMF. So when you do away with this bailout by reprofiling everything, you increase the information content of market prices. And the third advantage of reprofiling is that it preserves the integrity of the domestic and foreign bank balance sheets. So when you do a restructuring and a haircut in the beginning, you basically destroy the banks, not just domestically, but many other banks as well. And that's just very painful. And then you have to bail them out, so you spend the money twice. You can see it in the case of Greece, I mean, you do a haircut, and then you save some money, but then your debt to GDP goes straight back up because you have to bail out all the banks. So reprofiling, I think, has a lot of advantages, and I think it should become the standard procedure when in doubt about debt sustainability. And a final point is, I think reprofiling would very much reduce the need for huge global financial safety nets. Yeah? I mean, if we look at the European example, we had the programs in Ireland, in Portugal, and in Greece. Each one of them had a size of around 14% of GDP. And almost all of that money has been used to pay out private sector creditors, which I think is a bit of a waste. Yeah. So if you can do this reprofiling, this ex ante reprofiling, you save a lot of money. You don't have to have huge financial safety nets, and you can actually use part of the IMF programs to sustain aggregate demand and divert hysteresis instead of paying out external creditors who are not going to lend to the country anyhow. Yeah. So I actually think that we have a pretty good setup now with the change in the lending framework and the aggregation clause, and that reduces the need for huge financial safety nets.
Just some additional perspectives on global safety nets coming from my research and some observations. First, as I mentioned yesterday, crises are increasingly liquidity crises affecting a large chunk of countries at the same time. So the liquidity needs are going to be huge. Now the question is which one of these various options will fulfill that need at a short point in time. On that, actually, some consider Fed's swap lines to be the most credible because it is ultimately the issuer of the hardest of the currency, but these unfortunately are not available to emerging markets. So Fed issued its minutes, minutes of the meetings in which it decided which emerging markets will be offered these swap lines, and it was very categorical. These had to be the countries in which US was interested in having financial stability. So these were selectively offered to Korea, Singapore, Brazil, and Mexico, I think. And even then, the rules of the game for these emerging markets were different from the rules of the games that were offered to other advanced economies. So bottom line being that other emerging markets do not have this access to Fed lines. And I think Fed also discussed request, if I'm not wrong, from Chile, Indonesia, and Peru, and decided that these countries are not of sufficient interest to be offered the line. On other things, on bilateral lines, just some quick finer points on bilateral lines. These lines have not been exercised, right? So we don't know how they will work in practice. Even Chiang Mai initiative has not been exercised. So if you think about it, China and Japan are some of the biggest bilateral offerers of these lines, and they have offered it to multiple countries at the same point in time. When you add up the amounts, they are quite large. And again, if a large chunk of countries are in need of liquidity, you don't know whether they will be able to entertain such large needs from multiple countries to whom they have offered the lines. And if you read the finer points, even within these lines, so India, for example, has an ongoing line with the Bank of Japan. It was signed many, many years ago. It's for a limited period of time. It has to be renewed every 3 years. The amount has increased from 3 billion to 15 billion to 50 billion now. And it will lapse perhaps unless India realizes that it needs to sign up. The final point is that after the first 30%, IMF needs to be in a program with the IMF to exercise the rest of the line. So these are again not unconditional and have not been tested. So I guess all of these points out to the argument that perhaps reserves are the best hedge for emerging countries facing liquidity crisis along with the rest of the emerging world to meet their quick liquidity needs.
Thank you. Thank you very much. Last question. Most important.
Two very rapid points. I would take the discussion about the FX swap lines even a step further. I think the swap lines are no longer simply a crisis management instrument, and they have in fact become a much needed backstop to the global dollar funding market. It hasn't been reported very much, but in the last few months, the Bank of Japan has actually been tapping the FX swap lines of the Fed quite actively and provided dollar liquidity to Japanese banks on that basis. And that's not because there was a very acute crisis in Japan, but that's because you have actually, because of new financial regulation, a much more disintegrated financial system and far less liquidity in the global dollar funding market. And that makes the need for the FX swap lines a lot greater than it was before, even outside of an acute crisis situation. So I think that's something to bear in mind. The second point on the coordination of these FX swap lines, the efforts that were mentioned and by Korea have indeed failed. And I think, we can try to revive them, but I think it's probably wise to assume that central bankers are very reluctant to give away their power insofar as coordinating the FX swap lines to the IMF. So I doubt that this will happen. So maybe an alternative, and that's open for discussion, is whether the BIS, which is probably a forum in which central bankers have a bit more confidence, or at least where they feel more empowered, could be an alternative.
Thank you very much. Lots of questions, good questions. Luckily, I don't have to answer any of them. so now let's turn to speakers. Governor Guzman.
Sure. I was not as lucky as you are, so I'll try to address all the questions that were addressed to me. First of all, well, it was I understood it was a question from Pablo to all of us regarding the functioning of the experience of the Europeans with the regional financial arrangements, and the question was if, in our view, this could be considered to be a successful experience. My personal opinion is that it has been successful. This is, in fact, the most important test that we have had so far of the functioning of a regional financial arrangement. And this comes from two elements, I would say. The first one, the willingness and the possibility to provide a significant amount of resources. I was mentioning before that most of the regional financial arrangements have not really been tested, and this is one that has already been tested. And then an additional element that I think is important from the European experience is the sort of background that we have had, the test case that we have had on possible coordination with the IMF. And then the third element that you have to consider is that so far the results have been successful. We cannot say that Europe is out of the woods yet, but I think that so far you can be said that the working of this mechanism has been successful. So my overall assessment of the European experience is positive. That does not mean that you have faced a number of challenges, and we know that the relationship between the IMF and the European Stability Mechanism has not all been smooth. There have been some differences of opinion, particularly the case of the treatment of the Greek experience and the sustainability of debt there and so on. But, well, even there I would say it is healthy to have different points of view regarding the situation of an economy. My assessment overall is of a positive experience of Europe with this issue. Then the second question was posed by Pilar on the FCL. And there the concern was, is this too costly for the IMF to have FCL arrangements that imply a very large amount of fund resources? And then the possibility, I assume, is behind that question, that the fund will not have enough resources to provide to other countries that may need it, particularly if you have a situation in which there is a higher number of countries requesting arrangements like the FCL. But I think the challenge here is not related to the demand for the facility. If we have a demand for a facility of this nature, I think that is a positive element for the world economy, because the central element of it is of a preventive nature, and a preventive nature for countries which have strong fundamentals, and this considers a widespread number of elements. So the issue is not, the problem is not that we have a significant number of countries requesting the FCL. I see it the other way. The problem is why we don't have a significant number of countries requesting the FCL. So what is the challenge there? The challenge is rather to make sure that the IMF has enough resources to meet these demands. So I see it from a slightly different perspective. Then there was a third question by Jean-Pierre Landau, and he was asking if Mexico is a unique case, a special case, because of a long history of relationships with the IMF. I would say that to some extent you could say that. We have had a very long history of relationships with the IMF. I think overall the relationship has been very good. It has been very productive for Mexico. That helps a lot, of course. It's not the situation we have seen in Asia, in which there was a lot of controversy about the results of the fund programs. I have to say that in the case of Mexico, the experience has been, there has been a lot of input on the part of the Mexican authorities on fund programs. That is to say, the degree of ownership in the case of Mexico has been clearly much higher than in the case of other economies, and particularly Asia. This provides an additional element in favor of this relationship between Mexico and the IMF. And that is the stigma. You have to take into consideration that the problem of a stigma is not only related to the reaction of the political system in a country to the use of fund resources. It starts with the attitude of the financial authorities towards the relationship with the IMF. In many cases, even if possibly you have a negative attitude on the part of the political system, the negative attitude starts with the financial authorities. And if you have that, it is impossible basically to go into a program like this with the fund. And then you were making an additional comment on the need to have unconditional resources under certain circumstances. I would say, if I give you my response from the perspective of a potential user of those resources, I would say I would definitely agree with you. We would love to have unconditional access to resources, but the problem is on the other side of the table. On the other side of the table, on the countries that are on the creditor side, there is a lot of resistance at every level to provide unconditional resources. And there are reasons for that. We have to understand it. There is the possibility, a clear possibility of inadequate incentives for policy implementation, and related to this, of course, the risk of moral hazard. In fact, one of the main problems that we have, and I was mentioning that before, regarding some of the new elements of the global financial safety net, is precisely concern related to this risk of moral hazard. Then Alejandro Werner was asking about the swaps and regional financial arrangements, and if these are second-best solutions. I would not say they are second-best solutions. I would say they should be an important part, an important component of the global financial safety net. The challenge here is how to make them work, because, someone was mentioning before, but I think it was Eduardo, in the context of the crisis, we had a proliferation of bilateral swap arrangements, for instance, but after a relatively short period of time, most of them disappeared. All of the swap arrangements that emerged during the crisis that involved the participation of emerging market economies are no longer there. And in fact, some of the other swap arrangements that were made with a number of advanced economies also disappeared. The only surviving ones were the ones that are among the major advanced economies. And the reason for that is a lot of concern, again, about the possibility of moral hazard if you have ex-ante agreements with emerging market economies and with other advanced economies. So the challenge here, and the challenge in the case also of the regional financial arrangements, is how to make sure that they are going to work. And given the concerns there, I think there is an important element of fund involvement. You have to take into consideration of some, in a number of cases, in the existing regional financial arrangement. Take into account, for instance, the Chiang Mai Initiative. They provide, under the Chiang Mai initiatives, countries can have access only to a very small amount of the resources available without a fund program. And why is that? precisely because there is a lot of reluctance on the part of the creditor countries to provide financing in the absence of appropriate conditionality. And that is the same situation in the case of bilateral swap arrangements. Then there was a question about intervention in the foreign exchange market by the Bank of Mexico and by Peru. Of course, I cannot answer on behalf of Peru. I will give my point of view in the case of Mexico. Well, as you know, we had in the case of Mexico a number of intervention mechanisms in the foreign exchange market that were based on rules. We thought that would provide more transparency, better rules of the game, and so on. They worked for some time recently. After a certain stage, they did not work anymore. We had to get rid of them. And then we moved to a system of intervention in the foreign exchange market in which we are based on discretion. Communication is an extremely difficult exercise. We have been insistent publicly on a number of occasions under what circumstances we would be intervening in the foreign exchange markets, and we have said that the rules here are a situation of significant volatility that we consider is a temporary situation. Of course, you cannot face a permanent shock with the use of reserves because you are going to end up without international reserves. And the third element that we have mentioned is that it has to contain an important element of domestic source of uncertainty. So those are the three elements that are now guiding the intervention of the central bank in the foreign exchange market. We have also insisted that we will be using that on an exceptional basis. That is to say, really under exceptional circumstances, because of course you cannot allow international reserves to fall below a level in which that becomes a source of uncertainty. Then there was an additional question related to the situation, to the question that was asked by Alejandro on, the IMF should be at the center of the global financial safety net or not. And the view was, you can imagine the IMF at the center of the global financial safety net only under circumstances of a global shock. And I would go back to the other element I was mentioning before. To use the resources of regional financial arrangements, to use a significant amount of resources in some of the most important ones among them, and it is not only the Chiang Mai initiative, it is also the case of the initiative that has been set up by the BRIC countries. Beyond a certain level, which is in fact very small, you need to go to the fund, you need to have a fund program. In the case of Mexico, we have also a sort of a regional financial arrangement in the context of NAFTA. It is the North American Financial Agreement. We use resources. We have a swap arrangement with the Federal Reserve, with the Treasury, and with the Bank of Canada. In the case of the U.S., they also ask not a formal program with the fund in the case of Mexico, but a letter from the managing director of the IMF endorsing the economic policies in Mexico. There is a role for the fund. The problem is that, and I understand it, there is a concern about the countries participating on the other side of the table about the safety of the resources they are providing. So the role of the fund is not limited to problems of a global financial crisis. They have a role in regional financial arrangements, and they have a role also in bilateral swap arrangements. And then there was finally a question of regarding the Korean case. They have been. I agree totally. They have been. They pushed this very strongly in the case when they were chairing the G20. The response by the advanced economies was, we do not want this. We do not want this because we are afraid of the moral hazard related to that, and also because of the mandates and so on. And I think that one element that deserves to be explored, and I am thinking this on the basis of the Mexican experience, is there a role for the fund as a source of confidence for advanced economies to participate in these sorts of arrangements. In the case of Mexico, it has worked.
Let me go back to the distinction I had made at the beginning. I think that the global safety net has two objectives. One is crisis mitigation, and the other one is crisis prevention. And it's been very good at crisis mitigation. It's been, failing as crisis prevention. In order to have crisis prevention, you need to have predictability, and that's why I go back to the lender of last resort, domestic lender of last resort model. It's true, there are conditions. There is a difference between conditionality and automaticity. I mean, if you go to the lender of last resort at the domestic level, if you have the eligible paper, you know you will get the liquidity. And we're talking about liquidity crisis here. So then going back to your question, probably the European case is not one of those. So even though there are some conditions, and very strict conditions actually, you have to give back the money soon enough. Otherwise it will be intervention, there will be something bigger, like an IMF program with corrective action. But what we don't have now at the international arena is this automaticity, this standing facility that tells the market every country that suffers an externally driven liquidity shock will have access to liquidity, to international liquidity, for sure. That we don't have because we don't have the political will, particularly the marketable collateral that reduces the credit risk. That's at the center of the moral hazard problem that Javier was mentioning. I mean, that's why the central bank swaps has been limited to a very specific cases in which this credit risk is not an issue, or maybe because of political issues is not, political reason is not an issue. So let's stay with this distinction. What I think is missing is the crisis prevention issue. Now, going back to the question by Alex, I think a question of whether the IMF was, whether these CBAs and regional and central bank swaps and regional arrangements are second best to the IMF. I would say the short answer is yes, but not because the IMF is the ideal model. The ideal model is actually the central bank swap. I mean, ideally, the liquidity safety net would be the Bank of Japan and the Federal Reserve giving central bank swaps to everybody, something that's obviously not going to happen. So how can we improve upon that? The regional arrangement tries to substitute for this missing collateral by imposing some political affinity, so to speak, the peer control. Why the Latin American Reserve Fund has a credit status that is much better than any of the members? Well, because there are some peer control. When I mention peer control is essentially what I think of this, and the underlying reason for this preferred creditor status is it's written nowhere, but people think that at the end of the day, the Latin American Venezuela will default with anybody but the Latin American Reserve Fund. Let's put it in this way, or same of Argentina. And the ADB, exactly, and all those, exactly. Because no, but it's true. It's true. That's why the IDB, the multilaterals, can add some value in this intermediation, right? The problem with the regional arrangement is that you're not immune. We are not immune as a region to systemic shocks. So the IMF, that's where the IMF comes, right? Can the IMF, by their surveillance power and their technical ability, substitute for the missing collateral? That's the key question. So far, it couldn't. The FCL is limited. But it's making some progress. Obviously, there are more FCL than there are central bank swaps from the Fed. So there is an improvement. There's still something there is difficult to close. How to actually substitute for the collateral so we actually can have a standing facility for all countries involved, not only for the few that can have access to the FCL. Finally, then going to Europe, well, I think that this is not the right question, because in Europe you didn't have a liquidity crisis. You have something closer to the typical IMF program that the IMF was not so willing to execute, so it was partly executed by the European countries. But at the end of the day, it's a different case. I don't think the financial safety nets, as I understand them, are the instrument to address the European-style programs.
Thank you so much, Andy. Yeah.
Very quick. So on Pablo's questions, my own view is not particularly well. I mean, Europe managing its own affairs, and we dared to write a paper which is published in the Journal of Banking and Finance with Eduardo Fernandez Arias and myself, which has some very dangerous title like the European Financial Crisis, Lessons from Latin America. And this paper actually won a prize in a European finance conference, so the Europeans, at least the ones at that conference, clearly liked it. But I refer you to that paper. I mean, I'm not sure I completely agree with Eduardo. Eduardo's kind of very good at defining a problem which then this is supposed to address, but I actually think the problem is bigger, and it's very hard to just define the problem in the way that Eduardo likes to define it. So I think sometimes we sort of talk at cross purposes because of that. And that relates to Jean-Pierre's comments as well, I think. I very much like your idea of sort of having, if I understood it correctly, having sort of different layers. So you would have sort of one layer which is to do with systemic shocks and another layer which is to do more with the idiosyncratic shocks. We actually, we try to do that in some of our facilities. So one of our facilities, has some triggers. So if the MB, the overall MB, so not the country, but goes above some level, or commodity prices fall or something like that, then you get automatic disbursement, and it's automatic, right? Of course, this could be a liquidity problem. It could be a solvency problem. If it's a commodity price and you're, Peru or Chile, so this is not liquidity versus solvency, but it's an external trigger. It's an external shock that clearly, and then that's automatic, but. So I think we need to think of these sort of different layers and the ways which they interact. I very much like that idea. On your second comment, Jean-Pierre, so the theory is it goes the other way to, you were talking about STRM, and the theory is it sort of goes the other way to the one you were suggesting. And game theory can be very counterintuitive in this regard. so the idea is, if the IMF had more sticks, I just use IMF here as a sort of simplistic way. If the IMF had more sticks, then it makes this first best more likely, so then actually the debt restructuring becomes less likely. And if the IMF had the theory goes that the IMF might resort to STRM more likely if there was an STRM than the current ad hoc system we have at the moment. If that's true, then it makes the first best more likely, which then makes debt restructuring less likely. So there are many assumptions there which you can sort of pick at, and that I fully accept. So this doesn't necessarily cover every case, absolutely, but it's that's kind of the theory. There was a question from... Oh, Christian's reappeared. Okay. I was about to say I won't. But he reappeared, so now I can answer it. But I'd like to answer it because I think it's an important point, which I think also sort of related to something Alejandro was saying. I mean, I have nothing against reprofiling per se when it's the right thing to do. So, I mean, the sort of... Let's categorize three approaches. One would just be liquidity support without any kind of debt restructuring. One would be reprofiling, perhaps with some program attached, and one would be debt restructuring, which may also have a program attached and coming later. I think the emblematic case of liquidity support without any restructuring is Brazil 2002. Is that right? Well, in Mexico 94, absolutely. Two emblematic cases. And so whatever, I hope that in the new framework that the IMF has, that is still a possibility. I believe it is, and it very much should be. So there should be no sort of, just automatic resort to reprofiling in those circumstances. That would be a disaster in my view. Now, what you notice in that graph that I showed that has two peaks is that there's sort of no reason for it to have two peaks, right? I mean, why isn't it just like a normal curve? Why is it all being shoved to reprofiling? Plus the fact that you have these multiple reprofiling. So we have cases in the region, Jamaica's reprofiled twice, Belize has reprofiled twice. I wouldn't like to put a probability on any future reprofiling in both countries, but there are still issues in both. They haven't really got rid of the underlying debt problem. So these are just, particular cases of this more general phenomenon. So reprofiling is good where that's going to work, but it's not necessarily the right answer when something else is maybe required. I think I'll stop there. I think we all need coffee, right?
And also tea. Thank you so much. I think now So now let me conclude this session. I think the session really has covered a lot of substance, a lot of ground, and so let's thank the three speakers for their really insightful remarks and views. So we have covered a lot, but there are three issues I think probably Mark and the Governor we can program for next meeting. One is the role of the SDRs and also the international use of SDRs in this particular exercise, which is very important. We didn't touch upon. We didn't have time. Secondly, is the financing instruments, arrangements for low-income and developing countries. So we've had about 70 to 80 countries there. What to do, right? How to work with them, how to help them. Thirdly, I think, what kind of financing instruments, arrangements should we have to deal with non-economic issues or shocks, such as a refugee crisis and many other issues. Anyway, so we will leave these issues for next round. Now let's take